by going from, those that trust you without even investing in you first to those that don't know and trust you, then invest with you, then gain trust. For me, I found it to be an advantage because I mean, you better spend extra time and put in more effort with their money than you even do on your own. That's how we still think about things today.
Welcome to Multifamily Insights. I'm your host, John Casman, and we're really excited about another great episode today. Listen, if you are an avid listener show, we want to hear from you. Give us some honest feedback, leave us a rating and review. And if you have not, make sure you hit that subscribe button or at least hit that follow button on all the platforms so you don't miss an episode. We got a great show today. We're going to be talking to Mark Khuri. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Mark, welcome to Multifamily Insights. How are you doing today?
I'm doing well, John. Thanks for having me.
Awesome. Hey, Mark, why don't you give our listeners 2 minutes of a background just to get to know you a little bit better?
Sure. Yeah, I'll start. Just my career basically began, guys, in finance. I worked as a financial analyst for corporate America for a number of years, transitioned into another role, getting a W-2 as basically working in operations management for a private distribution company. So what that means for me, it's I go back to those days, John, as those W-2 days. Really started out in investing in real estate on the side, very active after work, buy my first fixer-upper, live in it, house hack, take some equity out, partner with my brother, buy a fourplex, renovate the heck out of it, takes too much time. You learn the lessons the hard way. Did that for 5 years while working in corporate America, partnering just with family, my brothers, my folks, actually my aunt and uncle. We built up a small portfolio of properties. We were buying just single family, small multifamily assets in a few different states. All of it, though, was direct from the bank, heavy cash, all cash purchases, a lot of boarded up properties. Value add, right, was where we really focused. There was a lot of great deals at the time, John, and had we looked back now, geez, you could have just bought everything and not even thought twice, right? But it's also a scary time. A lot of uncertainty, the stock market crashing, the recession, you name it. So until we got our start, we went full-time into real estate in 2010, opened up our company, SMK Capital Management. That's my father and I's initials. We partnered with each other to essentially expand on what we were already doing as a family. Started raising capital outside of just the family with some friends and colleagues and coworkers and just people that already trusted us and liked us and that we knew and had established relationships with. And so we continued to buy a lot of distressed properties and operate them from A to Z, all in-house with a team that we had built, of course, to assist with everything on the ground. But we also started expanding, my personal investing. I had left the corporate world. I had a 401k sitting idle. I opened up a self-directed IRA. I went on this, kind of this 2-year networking binge, I call it. Went to tons of investor group meetups and listened to a lot of people, lectures, and much more savvy experts in certain niche sectors within our space. And kind of got hooked into a few different asset classes. I was looking for diversification, John, and started investing in mobile home parks and self-storage and some larger institutional apartments, really looking for something that had done well during the recession. And there wasn't a lot back then you could show and point to data and say, gosh, this has actually fared quite well. And so that became a big focus. And what we ended up doing for the next 5 years, our family, myself, were just investing as LPs in other sponsors and operators deals. We ended up making over 20, 25 investments in 10 different asset classes. and all the time doing our own deals as an operating partner. And so what we ended up having at the end of, about 5, 6 years was, gosh, a pretty good data set. We could compare risk and return. We could compare asset classes. We could compare strategies within those asset classes, different operating partners. And we ended up kind of pivoting in 2017. So about 7 years ago now, we decided to stop being an operating partner and sponsor and just focus on what we continue to do today is private equity, real estate investing, syndications, utilizing a lot of the relationships that we've built with partners and sponsors. We focus on diversification across asset classes, regions, operating partners. We create multi-asset funds. We also invest in single asset opportunities. We're really looking at 10 to 20 investments a month. We invest in 5 to 8 a year. So about 97% of the deals we see, we don't invest in for a number of reasons. But essentially, that's what we do today. Very, very proud of our history. It's been a lot of lessons learned and a lot of experience, but I love where we ended up nonetheless.
I love it. I love it. Mark, you gave us a lot of great feedback on your background, right? So you talked about starting off as a financial analyst, working that W-2 job, starting investing on the side, and you balanced that for 5 years, really focusing on deep value add deals, really distressed assets, buying them, pouring in a bunch of capital, fixing it up, and then renovating them and having them ready to go from there. Doing that, expanding it, working with your family, working with your father, your family members there, slowly started to bring that to friends and expanding kind of your circle, ultimately launching SMK Capital. Now, today, you've invested more as LPs. You kind of partner with other folks to identify the right opportunities for the entire group to come in and invest in. And you mentioned that at one point you did around 25 deals over a 5-year period as an LP. So let's talk about kind of that transition there, right? You mentioned doing kind of the deep value add deals, but then investing as an LP. But I believe you said you were still going out there and finding these deep value add deals while you were investing passively. Talk to me about kind of the strategy behind that, right? Because in some worlds, it's like, okay, hey, if you could just be passive, why not just put more money into being a passive investor as opposed to being active, or the flip, hey, if you want to be active, just be active, but you were doing both. Talk to me about why you thought it was important to balance both being an active investor and a passive investor at the same time.
Yeah, I mean, the number one reason for me is diversification, John. So we want to spread our capital, personally, our investors' capital, all capital that comes under our umbrella, in reduce risk. And that's the name of the game, right? Try and find a sweet spot where you can have the lowest amount of risk with the highest acceptable return. And that's part of our process every day, looking for something unique, something special. Why this deal, not that one? And what makes this one different? And why does it help us reduce risk? At the end of the day, when we're looking at investment options, John, I always want to come away by saying essentially that we have a very strong conviction that this investment is going to meet or beat the projected returns. And there's so many deals out there, I'm sure you see this as well, that every assumption in the pro forma has to kind of line up in order to just meet the projected return. There's not a lot of wiggle room. There's not a lot of padding. And there's a lot of fluff sometimes built in. And so that's the kind of stuff we watch out for. But at the end of the day, it's all about diversifying and ensuring that, through good times, bad times, recessions, economic growth, that the portfolio is still performing and doing well.
No, I love that. You talked about diversification. That's really key, especially when you're starting to scale, right? When you have that capital, you want to, diversify your investments, because if one deal doesn't work out, like, it's not the end of the world, right? You've got other deals, other investments, and typically the law of averages start to play out. Talk to me more about that standpoint.
Yeah, you're 100% right. So over the years, we've created and managed over 65 different investment partnerships with our investor groups. And so they don't all go according to plan, 100% correct. Even as much underwriting as the pros can do, and we do a ton, and due diligence, there's always risk, John. You can't avoid it. And so how do we navigate? What do we do? It's kind of a balance between, for us, we look at two things. We look at the operating partners that we're partnering with, the people risk, and we look at of course, the asset and the market risk and the business plan risk. And to us, honestly, the people risk is one of the hardest to decipher versus the asset and the market. And so a lot of our deals come from relationships where we have active capital invested with folks, and trust has been built over a period of time, typically a longer period of time. We can see how they operate existing investments, how they communicate, what happens when the business plan is supposed to go right, but the market's going left. What do you do, right? And how do they pivot and adjust to these kinds of changes that happen all the time? And so by doing that, and by doing it for long enough, you end up having enough of a Rolodex of operating partners that truly are the best in the business, and you continue to grow together by investing more and more over time. So I don't know if that helps answer the question, but a little bit how we're looking at
Yeah,
things.
Mark, give me one insight you've learned from investing as an LP that maybe you would not have gathered just doing deals as an active investor.
Yeah, let's think about that. So active versus passive as an LP on passive. One thing that comes to mind, you got to give up trust to other people. There's nothing you can do. If you want to be active, great, go ahead and do it. It's very hard to scale. It's hard to get your time out of your life and not get sucked into the minutia and the micromanagement and the details and hiring and firing and all the other things. So if that's part of what you want to do, great. But you also learn that being passive, you have to give up trust because you're not in control of everything. And that's not for everybody. I would highly suggest most people try and do both. And that's what a lot of our investors do. A lot of them have active businesses that they run, maybe not in real estate. They're entrepreneurs, very much charging 24/7, focusing on that business and investing, but also doing a lot of passive investing as well. And so I think the lesson learned is there isn't a perfect way that fits all. It's figure out what's best for you, maybe do both, and try and reduce your risk, right? One of the big things for a lot of our active business owner investors is, I want to not be in full control of my entire financial picture in case something happens to me, right? You could get sick, you could pass away, you name it. And so if everything's in your own business, you get the picture there, John, but it's good to spread out and diversify your capital outside of what you have under your nose and in full control.
Yeah, you talked about, giving up trust, which I took to mean, giving up control, right? And having that trust in someone else and giving up power. You're really hoping these individuals are making great decisions. You talked about the people risk, being a big challenge up front and making sure that you're investing the time to get to know these people, understand how they operate, how they communicate. Talk to us a little bit more about how you vet the partners you work with. Is there kind of one go-to question or strategy, or how do you kind of, laser focus on vetting those operators and partners?
Yeah, a couple things. Most of our operating partners today come from two areas. One, we already know, like, and trust them. We have active capital with them. Or two, they're referred to us by someone else who knows, likes, and trusts them and has active capital with them. That's where we receive our, I would say, newer operating partners from. Now, once we're looking at vetting an operating partner, there's a systematic approach that we have, John. It starts with getting to know the firm much better and looking at their history, their background, how have they grown, how quickly have they pivoted from asset classes, or are they a specialist in one thing? Do they specialize in one market? Or are they invested in multiple markets, and how do they do that? What makes them special? What makes them unique? Do they have any kind of secret advantage, if you will, that allows them to maybe get better deal flow than others, or to underwrite better, or to know a certain market better? Maybe they've got a very strong local presence in a market and they dominate, and you can try to understand the whole firm as a holistic approach of, is this the type of firm that you want to work with? And then you can dive into the weeds. How have they done? Look at previous investments, projections versus actuals. Look at actual statements that they send to their investors for the last couple of years? How do they communicate? Is it clear? Is it transparent? Or are you reading something, then you find out, gosh, I've got 15 more questions that they never even addressed? When you are communicating with them, asking questions, how quickly do they respond? How thorough are they? Do they give you the time of day? Who are you talking to? Is it a junior associate with 30 days under his nose, under the job experience, or are you talking to the owner of the company? All these things make a difference, John. You're basically essentially placing a bet on other people, and you want to make sure that there is a really close alignment of character, of quality and pedigree, of work ethic, not just business strategy and projected returns.
Mark, I think that's a great way to think about it. You definitely want to understand the people, their background, their experience, referrals, their strategy. Do they have some sort of competitive advantage in the marketplace? All those things are really, really key. We've talked about kind of investing as an LP and vetting those sponsors and partners. Let's talk a little bit more about the active side of it. One thing you said earlier on that I love is how you expand it. You started with your own investments. You then kind of moved on to kind of your close-knit family, siblings, your father, and then eventually you brought on those friends and other people who are close to you. Talk to me about the importance of both communication and taking care of your investors, particularly when you know that these are people who are close to you.
Yeah, I mean, it's critical. It's absolutely critical, John. It's a huge part of being successful. It's not just returns. If people have questions like, is he hiding something from me? You never want somebody to ask that question internally. That means you did not do a good job communicating to them what's going on, pros, cons, etc. You need to be able to, it's something we do, like when we send out a quarterly update to our investors, we want to do two things. We want the response to be virtually none, because that means, in essence, we've provided enough detail and thoroughness where our investors have had their questions answered. And two, we want people to make sure they know what's going on with the investment. How's it doing compared to what we thought? Are there any hurdles that we've had to overcome? How are we overcoming them? And when do we anticipate the solution to be near, far, et cetera? How long is it going to take to get the problem solved if there is one? There's always something, right, John? I mean, no investment ever runs perfectly smoothly and directly according to the pro forma. And so a lot of them do better. Some of them fall short. Some of them are pretty darn close, but there's always a change of some sort in the business plan. So communicating that in a way that lets your investors know that we are on top of it and our operating partners are on top of it, and that we're handling the situation, whether it be good, bad, you name it, in a very pragmatic approach where the investor's interest is first. And then if there's a lot of deals, John, where you end up finding some low-hanging fruit that you didn't initially see in the underwriting of the deal, where you can expand the performance. So we like to explain what we're doing there. Here's how we're going to actually grow value even more than we initially thought by doing X, Y, and Z. And you can dive into a lot of those examples as well. And so that communication is always critical. Investors need to be feeling that you are providing them with the whole story, being transparent, and being truthful along every step of the way.
I love it. And I think it's so critical because you talked about know, like, and trust. And that trust is something that takes time to build up. And when you're dealing with people who are close to you, you want to protect them. You want to take care of those individuals. And it's not to say things are perfect. As you mentioned, every investment comes with risk, but you want to do everything you can to be transparent and communicate. And I think that makes you someone that they want to do business with moving forward. And I know a lot of times I'll talk to people who do not want to work with their friends and family. They've been taught that, oh, you should never do business with friends and family. You obviously started and kind of have a different perspective. Explain kind of your philosophy there.
Yeah, still to this day, a couple things come to mind, John. We always put our investors first, especially starting out with friends and family. Um, and you do that because, gosh, you sure as heck don't want to mess up, right? The bar is much higher when you're dealing with folks that you love and spend a lot of time with when you're managing their money. And so that bar has always been very high for us. It's been just kind of part of how we started again by just doing friends and family and then expanding. And so that communication I've talked about, that inherent trust, you can't slip up, not with any communication, not with any, you can't miss very easy much in your pedigree and your kind of cadence, I would say. Um, and so by going from, those that trust you without even investing in you first to those that don't know and trust you, then invest with you, then gain trust. For me, I found it to be an advantage because I mean, you better spend extra time and put in more effort with their money than you even do on your own. That's how we still think about things today. Um,
No, I love that. Yeah.
one lesson, John, that my father taught me many years ago. We were flipping a house and we were putting together some underwriting on the deal, and I ran the numbers 5 different ways. If this happens, that happens, stress testing it, you name it. And I was chatting with my father at the time. I said, "Look, I'm really confident that we're going to get our investors over 20% return, average annual ROI." He said, "Great, show them 15." Like didn't even blink an eye. And so that same concept of just, you know, under promising, over delivering, of course, the cliche, but doing it as much as possible with everything you say, right? Not just projected returns, but the way you communicate the business plan. For example, we're going to renovate 100 units at this apartment community. And if you actually think you can do 5 to 8 units a month, budget for 3 to 4, right? And see how it goes. So that same concept just holds through to just about everything we do today.
I love it. I appreciate you sharing that. It's really helpful. And I think to your point, just making sure you take care of your investors. If you're putting them first, the way I like to think of it is if you're taking care of those investors and you're doing what's best for them, why wouldn't you want the people closest to you to benefit? If I've got family members, if I have friends, like, of course I want them to make money on these deals that I'm doing, right? I trust me more than I trust, whoever out there on Wall Street. And it's the reasons you said. I know I'm going to put in the extra work. I know I'm going to, work even harder because of the people that we have involved. And I think that mentality just serves people well. If you have good intentions, if you're truly serving those people around you, you're going to want them to succeed. I think it's almost a red flag if you don't want people closest to you in your deals. It's like, well, why not? That kind of concerns me just a little bit, but I love hearing your perspective there. You talked a little bit about underwriting. Let's talk about that right now. When you are looking at kind of deals, especially in this current market environment, what are some of the tips and strategies you employ to underwrite deals?
Yeah, I mean, current market is challenging, John. We've got a very high cost of debt. We have in some asset classes, in some markets, stagflation, where rents are flat or declining and expenses continue to go up as a result of inflation. So you have net operating income flat or declining. That's not a good situation to be in. And that's essentially what stagflation is. And so we combat that a few different ways with different asset class selection and strategy, creating multi-asset funds. But when it comes to underwriting, a specific deal, um, going back to the ultimate question, do we think this investment has a high likelihood of overperforming and beating the projections? And that's a big one. And to get to that answer, there's a lot of things you can look at. I'll name a few, but in essence, you want to watch out for overly rosy projections, where things are just very aggressive underwriting, right? And instead, look at conservative underwriting. Some of the things you look at: historical T12, of course. How is the property done for the last 12, 24 months? How much data you can get? Analyze the heck out of that, right? And ask a lot of questions. What has the seller done to increase occupancy if you see a bump in increasing occupancy? Have they spent more on leasing and marketing? Are they offering concessions to get investor leads in? Are they reducing their requirements for residents to qualify for the unit, income requirements, you name it? So many ways that tell the story on the financials, and you got to dig in and figure out the why that trend is changing in the better. Because usually when you're acquiring, you're going off of most recent financials, and you want to know the story of how the property and the owners actually got there in the first place. So then looking forward, projected occupancy, it's a big one. A lot of asset classes and regions across the US have seen occupancy declines since the end of 2022 and through 2023 as a result of a lot of different things. So what do we think is going to happen going forward? And stress test it. Let's assume you think you're going to have sustained occupancy of 95% for the next 5 years. Okay, well, what happens if it's 90? And then look at your projected returns. What happens if it's 85? What's the break-even occupancy? How low can occupancy go until you are in trouble financially and the property doesn't meet its debt obligation? Then you look at rent growth projections, same story. How are we going to grow rents? Is it manual? Are we doing some renovations at the units? Are we relying on local market appreciation, or is it a combination of both? And how likely are these to occur, and what happens if they don't? And how stress test the deal again. Cap rates, big one. Still today, we are very focused on the going in cap rate versus the interest rate, the borrowing of cost of the debt. We want a very healthy spread there. And we're looking for usually between 75 to 200 basis points of going in cap rate versus interest rate spread. It's hard to find, John. We dig and dig and dig until we find that. And it's a big part of our analysis to date, simply because it helps reduce risk. We have a lot more likelihood of having in-place cash flow day one. Exit cap rate. Where are you buying it at? Where do you think it's going? That's a tough one. In the last year and a half, we've seen cap rates expand across just about every asset class, some more than others. Where do you think it's going? Do you think it's going to go back down? Are you putting that in your underwriting? And if so, how much? And how do you justify that? And what happens if they don't? Again, stress test, look at different exit assumptions to see what kind of returns you'll get if the cap rates stay the same, or maybe they're going to go up another 150 basis points. If it doesn't pencil anymore and the deal doesn't make a return, be very careful, right? These kinds of different tests you can do to deals. Of course, basis, what are you buying it for? Right now, like when we look at deals, John, two things we're looking for. One, we want it to have hair on, right? It's got to have something. It could be a recent deal we did, for example, mom and pop owned self-storage facility. They were in their 80s. The husband died. The wife doesn't want to deal with it. They stopped collecting rent literally for 6 months. Occupancy dropped. They're not even leasing. You go try and visit the property. You put the address up on Google Maps. It takes you to the competitor's facility. I'm not kidding. So these are all the kinds of things we like to see when acquiring, because they can be fixed and you can immediately turn the property around with the proper management and insight. And then the basis you're buying at is extremely important today, right? Are you able to get a deal from peak pricing in 2022? I hope so. How much, right? And these kinds of things. Another
Mark,
one we look at, just to kind of summarize here, we look at operating expense ratios. It's a big one. In some of our self-storage mobile home park asset classes, 30% is common, whereas a single family home, for example, it could be 70, 80%. So there's just a lot less meat on the bone. So we love to see low operating expenses as well.
Yeah, Mark, you just hit on a few things, man. But the biggest thing to me is just understand the story, right? When you're underwriting, and I think this is counterintuitive for some people because most people think of underwriting and financial analysis and they think numbers. What you're talking about, though, is understanding the story behind those numbers. Why? What's the why? Is it because, like you said, one of the owners, the main manager, passed away? Did something change with the management? Like, what's behind the numbers? What's the story? If occupancy shot up, but why? Did they start doing incentives? Did they start doing concessions? Like, did they lower rent? Did they remove their restrictions on who they let in? Because you need to understand what you're going to be walking into day one. Just because that place is filled doesn't mean everybody pays rent, and it doesn't mean everybody's qualified, and it doesn't mean it's the kind of community you want moving forward. So all these things are really, really important, and it has nothing to do with the numbers. The numbers are important, but what's more important is understand the story behind the numbers so you can put together a proper business plan going forward. Mark, really great insights right there. For our listeners who want to learn more about you and your company, they can go to smkcap.com and learn more. So we advise you to check that out in our show notes. Right now, we're going to transition to a round of insights. Mark, give me a failure or an apparent failure that sets you up for later success.
Gosh, okay. There really isn't one thing that comes to mind, John. We run a real estate investment business. It's hard. We're always faced with challenges, with market issues, you name it, from the recession in 2008, the crash, drop in values shortly thereafter, rents came down. We went through all that. We've had fires at properties, total losses. We worked through several large storms in Texas. Storm Uri, if you recall, a couple years ago, caused over $4 million in damage to one property. Hurricanes, we've been through all that stuff. And so obviously the global pandemic, rising interest rates, the fastest pace in over 40 years. All these challenges have been very hard. I'll say this, for us, it's just, I look at it like you really have to be very strong. You have to have a strong spine to deal with all this, right? We're really in the problem solving business, I say. To be successful, you want to build your inner confidence to a level where you believe that, no matter what problem you face, you'll get through it. And so I hope that helps, but that's how we look at things. It takes time, it takes experience to get to that level, of course, but we've been through a lot and seen a lot of crazy things over the years.
Give me a digital or mobile resource you recommend for your business.
Digital or mobile resource? What do you mean by that? Maybe I'm not.
So any like an app or anything that you use to either help analyze deals, talk to investors, anything like that.
Here's a simple one that a lot of people don't know about. It's not really real estate focused, but Genius Scan on your phone. It's an app. You can scan any document and create a PDF by it and just email it.
There you
so
go.
You don't need a scanner anymore. That helps some people.
Absolutely helps with those documents and those paperworks, right?
That's right.
All right. Give me the book you recommended or gifted the most in the last year.
Oh, let's think here. There's definitely a few there. I would say one that I like a lot is Steven Schwartzman's What It Takes. He's the founder of Blackstone. I just like it's a great story of some of the challenges, hurdles, the achievements he's been through in his life to create the largest alternative investment firm in the world. I found that one quite compelling, something I would recommend folks take a look at.
What's a daily habit that helps you stay focused on your goals?
I always take time to reflect on what's going on in the bigger picture, thinking 6 months ahead, but also several years ahead. And then Ray Dalio has a quote, and he actually says, "Don't think years ahead, think decades ahead."
Love it. Love it. All right. Give me your number one insight for investing in commercial real estate.
Number one insight would be surround yourself with the best of the best and don't quit and settle for anything less.
I love it. All right. You are out there in Bend, Oregon. Give me your favorite place to grab a bite to eat.
Bend, Oregon, favorite place to eat. Spork is a great one.
All right, not familiar with Spork. We'll have to put that on the list. I'm not sure if I'll make it out to Bend, Oregon, but maybe
let me know if you
do. Well, Mark, you gave us a lot of great information today. I appreciate hearing a little bit about your story and your background, juggling the 9 to 5 while investing on real estate on the side with your personal portfolio, starting to work with your family to expand that, ultimately bringing on other investors and launching SMK Cap, and then hearing how you kind of balance being an active investor, finding your own distressed deals, renovating them, while also investing passively and ultimately bringing those opportunities to your investors. Again, if folks want to learn more, they can go to smkcap.com and check you out there. Mark, thanks again for coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
Thanks, John.